We're going to talk to you right off the bat about the state of the residential housing market in America. Is there any relief in sight for people who are looking to find some kind of rent stabilization in the coming months and years?
Well, thanks, Tom. There is, absolutely. So when you think about single family and multifamily rentals, it's been a very, very strong market. There's no question about it. But rents are coming down across the country. We had the massive pandemic demand push that happened in 2021, 2022. That backed off a bit in 2023 and 2024. But what the real story is supply. So supply is at 40-year highs right now. And the interesting thing is that a lot of people thought the rental market would collapse. And for good news for our company and other multifamily companies is that the market hasn't collapsed, but it has slowed. I mean, rents were up 13% in 2022. They're up 3% in 2023. And now we're seeing 1.5% growth in 2024. Now, that's a significant slowdown, so it's helpful for renters, but also it's helpful for the Fed and the CPI. That CPI number is backward looking probably at least 8 or 9 months. So the good news is the CPI will continue to fall in terms from a rental perspective because the market is slowing, but it's not collapsing, which is really a positive thing for these stocks and for companies like Camden.
Rick, is it safe to say then that with the housing market the way that it is right now, with interest rates kind of moving the way that they have been ever since the great financial crisis, and now with the housing dynamic, that there's a secular trend towards renting for Americans versus owning?
Absolutely. So the challenge you have today in the single family owning market is that we're at a really big change in terms of what it will cost to own a home because of the doubling of interest rates, obviously. And so what's happening is that it is a lot cheaper to rent, like 60% less to rent an apartment than buy a house today because of high interest rates. Now, that will change over time as interest rates come down, but it is a really good time to rent. And from an affordability perspective, when people are getting pinched on their budgets, and it's cheaper to rent than own a home. As a matter of fact, today our rent to income is at one of the lowest percentages. We're at about 19% of people's income to pay rent, which is very low. Usually it's in the low 20s. So it's in a very affordable product today relative to single family homes.
Interest rates also play a factor, not just in how rents are charged and how much people pay in mortgage interest and mortgage payments. It also affects financing for building properties, which is what you do. How are those rates affecting what your growth plans are going to be in the coming quarters and years?
The interest rates definitely have, the interesting thing about it is the low interest rates and the sort of easy money in the last 3 years fueled the supply boom. Now what's happening is the reverse is happening. The cost of capital has gone up so high for developers that development starts have fallen. The last numbers that came out, they fell 53% from a year ago. And most folks believe that we're going to go to post financial crisis lows on new construction. So to put those numbers in perspective, we're building 500,000 units per year annually. That number is probably going to drop next year to a little over 200,000 units. And when you look at housing supply generally, both single family and multifamily, there's a real shortage of affordable housing in America. So when you stop the pipeline like it's been stopped, you're going to have a really interesting market. What's going to happen is you're going to have a stabilization of rents in this low 1% growth kind of area, which is good for CPI, good for the Fed, good for long-term interest rates. But what's going to happen in 2026, 27, and 28, you're going to have we have a soft landing, and you end up with still a strong economic scenario that happens in those out years. You're going to have outsized rent growth again, and we're going to be back to significant rent growth because there's not going to be enough supply for the demand that is needed just to fill household formation.